doing a series of scenarios that hopefully over the course of each, what would be conversations you might experience with your clients toward the end of the year, you'll get to learn about all the new things that might have changed during the tax year and for 2022. As of now, we have no slides, we have no handout. We hope that you will follow along with us in the scenarios, and then we will put transcripts of each scenario on the website when we're done. Our first code word for the day is going to be Julia, Julia, Julia. And with that, I would like to welcome our first guest.
Bonjour, bonjour, Monsieur Harris, comment ça va?
Bien, merci, et vous?
Oh, je vais bien, j'aime juste le Noël avec les bonbons, les biscuits, les gâteaux.
I'm so sorry, but that one sentence was all I remember from my high school French class, Madame de Rosa. Can we continue in English?
Oh, may we? I mean, I'm sorry. I mean, of course we can.
Thank you so much. So I know 2020 was a rough year in the restaurant business. Has 2021 been any better?
Comme ci, comme ça. It's been all right. As you know, 2020, both of my restaurants were shut down for several months. And when we reopened, it was not at full capacity. We never would have survived the year without the PPP loan from the government.
Yes, I remember helping you with that application. That was quite an ordeal. You were able to get it fully forgiven, right?
Oh, yes, I was. I remember thinking it would be tax-free. And then you told me I owed some money to Virginia?
Yes, unfortunately, Virginia was one of a few states that didn't allow full deduction of expenses paid with forgiven PPP loans. They only allowed 100,000 of those deductions. Did you get a second PPP loan this year?
Oui, yes, we did. We were still down quite a bit from before the pandemic, and those amounts helped me keep my staff fully employed. Even with those loans being forgiven, though, we are still barely getting by.
Well, you were able to take the employee retention credit, right?
Yes, you helped me to amend my payroll tax return and take that credit for 2020. It was so nice of the government to make that change. It's too bad I cannot do it for 2021.
Actually, you can. The ERC, the employee retention credit, was extended for 2021. First, just for the first 2 months, the first 2 quarters, and then for the full year. And actually, they made it a whole lot better. So if you'll remember, the ERC for 2020, you as long as you had a 50% reduction in your gross receipts from the same quarter in the previous year, or if you were subject to a government shutdown that could have been full or partial,
then we were.
Oh, I remember that you were. So we were able to qualify for the employee retention credit for the second, third, and fourth quarters of 2020. And remember, you got that PPP loan, and originally we thought that you wouldn't be able to take the employee retention credit because when it first came out, they said that anyone who took a PPP loan and plans to have it forgiven was not eligible for the employee retention credit. And again, fortunately, that's something that changed actually after the end of last year. Congress changed the law and said that you were able to qualify for that credit. If the only reason that you didn't take the credit last year was because you had a PPP loan, you could go back and take it. So we did. Now, the one caveat was that, remember, we couldn't use the same salaries to justify forgiveness of the PPP loan and to qualify for the employee retention credit. So that was a significant limitation in a couple of those quarters. Once you got your PPP loan, you had a 24-week period to incur expenses that were eligible and used to justify forgiveness of the loan. And when it first came out, we thought that almost all of those expenses would have to be payroll. But then again, they changed the rules, and up to 40% of your expenses could be non-payroll related. So it could be rent, it could be utilities, and all kinds of other things. So we were able, when we filled out that application to get your PPP loan extended, we were able to use the minimum amount of payroll, and we're even able to kind of pick and choose which kind of payroll we use to justify the PPP loan forgiveness, and then we can maximize the salaries that were still available to take the employee retention credit. But last year, the credit was limited to a total of $10,000 of compensation per employee for the entire year. And the credit was 50% of that amount. So you could qualify for a maximum of $5,000 per employee for the employee retention credit, which in your case was still a substantial amount of money, as you remember.
Oui.
I know that was a big help to you. For 2021, they've actually made it significantly better. For one thing, and even though I know that you were operating at full capacity for most of 2021, correct?
Most of it, yes.
So you may not have qualified under the partial government shutdown rules, but if your gross receipts were down more than 20% from the same quarter in 2019, then that would be enough to qualify. So if you looked at the first quarter of 2021 and compared your gross receipts to the first quarter of 2019, if it was down 20% or more, then you could qualify for the credit. And then the really cool part is that once you qualify for the credit, then you keep qualifying until the quarter after you stop meeting the 80% or the 20% reduction. So if in the first and second quarter you were down 20%, but in the third quarter you were only down 10% from 2019, you can still qualify for the third quarter, but not the fourth quarter.
This is very complicated.
It's extremely complicated, but it makes it very generous. And here's what's even better. Now you can take not just $10,000 for the whole year for the employee, but you can take $10,000 per quarter for the employee. Not only that, instead of that credit being 50% of that amount, that credit is 70% of that amount. So you can have up to $7,000 per quarter per employee in employee retention credit. And that is basically free money. The amount of the credit that you take, if you remember when we filed your 2020 tax return, we had to remove from your expenses the amount of the employee retention credit that you took for that year.
Oui, yes.
Speaking of which, I'll bet you still haven't gotten that cash yet for the ERC, because I know for some of our clients, when we applied for the amended 941s, it took forever to get those checks.
Oui, I am still waiting.
So we and if we had maybe had this conversation earlier this year and I had talked to you more about the 2021 credit, you could have found some ways to get an advance on that and have that money even earlier. So I apologize for that. But we can go back and amend those 941s now and take that very large credit, which will be a really big help to you. So originally, yeah, it was, so they extended it for the whole year. So that's actually pretty cool, huh?
Oui, c'est magnifique. I will let you amend these returns, and then we can take it for the fourth quarter when we file.
Actually, unfortunately, while the ERC was originally extended through the end of 2021, the infrastructure bill terminated it as of September 30th.
Oh, that's a shame.
It is.
Speaking of the payroll taxes, though, I remember something about deferring some tax last year. Do I have to pay that this year?
You do. If you remember last year, we were able, when we filed your payroll tax returns, we were able to defer the payment of the employer portion of the Social Security. So when you file your 941, you actually have several components, several pieces of tax that you're filing as part of that. You're paying the federal tax that you've withheld from your employees' paychecks. You are paying the employer portion of the Social Security and Medicare taxes. You are paying the employee portion of the Social Security and Medicare taxes that you withheld. So there's a lot that goes into that. And so a lot of people thought that, well, when I file my 941, I'll just claim a credit for the amount that for the amount of the employer's Social Security, but that wasn't the way it worked. In order to defer, you had to actually not pay it when you made your deposit. So on that one, we were ahead of the game, and I advised you that you should pay less on your deposits after each payroll period so that you were not paying in the portion that represented the employer's Social Security. So we could do that all the way from the middle of March through the end of 2020. So now that amount was it was a reduction in your tax that was due on the 941, and it was a reduction of the tax that you had paid in because you didn't pay that amount in. And then that kind of goes into a little pool, and you have to pay that back. And the rule is that you have to pay it back first. Half of it is due by the end of this year, so you don't have very long to make that payment of half of that amount, and I can help you calculate what that is.
Oh,
And then the remainder of it is due by the end of next year, by December 31st, 2022. And you can make that payment via the EFTPS system, and I can help walk you through that so that you get that payment properly applied, because it's a very specific type of payment that you're making.
okay. Very, very good. I will make a note of that. Is there anything else I should know about?
Well, I know how committed you've been to giving second chances to some people who have run afoul of the law by employing them in your restaurant.
Yes, that has worked out very well for me, and it makes me feel good.
I'm so glad. You know, there's a credit we've been able to take for that, which was supposed to expire after 2020, the Work Opportunity Tax Credit, if you remember that, the WOTC. But it was extended for 5 years, along with several other credits,
Okay.
such as those for employer paid family leave. I know you might have had some employees who had to take some leave for various things, especially during these last couple of years. They also extended some empowerment zone incentives. And then if you make payments as the employer, if you pay your employees' student loans directly, you can get a credit for that. And that's also been, you can get a credit, but you can exclude that from their income on their W-2. So that's
Mm.
also been extended for 5 years. Then there were some energy credits that were extended for 3 years. And then there were some other energy credits that were just extended for 1 year. Lots of other little things as well, but nothing else that would apply to your business.
Hmm. Can I get the government to find me some workers? I cannot find anyone to wait tables or wash dishes, let alone a qualified chef. C'est incroyable.
Well, there are a lot of factors that go into that, but you are certainly not alone in not being able to find workers. It really makes you wonder how people are supporting themselves.
Not only that, I have to keep changing my menu because I cannot get my food shipments on time, and I have to keep raising my prices due to inflation.
It's definitely a difficult time to be a business owner. Thank you so much for everything you do for our community. Oh, and thank you for the chicken cordon bleu you brought with you. Ooh la la.
De rien. Au revoir, monsieur.
And scene. I will open it up at this point for any questions about anything that we have talked about during that session, ERC or any of the credits that were extended or so forth. And I am not seeing any such credits or any such questions. So at this time, we will do our second code word, which will be child, CHILD, child. Now we will take a brief break to prepare for our next section.
Good morning.
Hello, Ms. Downs. Thank you for seeing me on such short notice.
You're welcome, Mr. Duggan. I trust you had a nice Thanksgiving with your family.
Well, Thanksgiving is quite a big production for our family. You see, the wife and I have 19 children and 10 grandchildren.
Did you say 19?
I did indeed. The oldest is 26 and the youngest is 4. The first 4 were
Wow.
all boys. We named them John, Paul, George, and Ringo. Then the 3 girls, Kim, Chloe, and Courtney, and then a boy, Kanye. Then there were the twins, Brad and Angelina. Then 3 more girls, April, May, and June. Then 2 more boys, George the second and George the third. Finally, there's Caden, Braden, Jaden, and Hayden. And honestly, I can't remember which of them are girls and which are boys.
That is quite a unique family.
Well, the TV network sure thought so. We've been doing reality shows for years about how we handle all those kids.
Well, come to think of it, I think I've seen that show advertised. I didn't make the connection. So what can I do for you? I'm not going to be able to help you with that workshop you've got there.
Well, my house tends to be a bit of a mess with all those kids, and I try to find a little space to get some work done where I can. I normally don't get too involved in our taxes, but our previous accountant fired us. We brought TV crews into his office and accidentally broadcast some important people's tax information on cable television. Lesson learned. I left the cameras at home this time. Anyway, I have a few questions for you about our tax situation.
I'm happy to help as long as I'm not on a camera.
Well, aside from our Zoom camera, of course. Don't worry. The TLC cameras are in the other room.
Okay.
So the first thing is that I started getting these checks from the IRS in July. And I don't know why. They're pretty big checks too.
Yeah, those are a big deal for most families with children. There was a new law in 2021 called the American Rescue Plan Act. I'm going to call it the ARPA for the remainder of our conversation. It was an important tax act that caused a lot of changes for 2021. Now, about those checks, as you might know, in the past, you've received a tax credit for each of your children under the age of 17. It was $2,000 maximum per child. Well, the ARPA expanded this tax credit significantly. So for starters, do you have a child who is 17 this year?
I have a kid turning 17 just about every year. In fact, I have a set of twins that turned 17 this year.
And that's perfect. Those twins are going to qualify for the child tax credit this year. They would not have under the old rules because they turned 17. And not only that, but the tax credit has been expanded significantly. For all those children of yours, ages 6 to 17, how many of those were there? Maybe 10 or so?
I think I ran out of fingers. I don't remember, but it's a lot.
Well, each of those children will be eligible for you to have a tax credit of $3,000 for each of those, and then $3,600 per child for the kids that you have under 6.
Wow.
So it's a pretty significant expansion. Now, those 2 twins of yours that are 17, that will amount to a $6,000 credit for this year that you would not have been eligible for last year.
Wow.
Now, those monthly checks, you should have started receiving those in July.
Right.
Yeah. Well, Congress decided that it would help out taxpayers a lot if they didn't have to wait until April to get this tax credit. So they started sending out monthly checks that amount to 1/2 of what the tax credit is likely to be for you. Those monthly checks continued from July through December. So you will have got the last one this month. And that's in anticipation of the amount that the credit is expected to be when you do finally file your 2020 tax return.
Wow, that's pretty cool. That's going to be a lot of money. I don't think the government was thinking about families like mine when they passed that.
I don't think so.
I'm adding to the deficit. So that money that I'm getting now, that's in addition to the credit I normally take on my tax return?
No, it's really an advance on the credit. So the credit will be calculated, and then if assuming you qualify, you will have gotten half of it in advance. Now, if you meet the income requirements, you'll get the other half when you file your tax return. So for instance, as long as you qualify in full, you should have already received $1,500 for each of your twins and those other children between ages 6 and 17. And then you'll get the other $1,500 of that $3,000 credit when you file your return. Now, of course, there are income limits that apply to the credit. It's reduced greatly if your joint income is over $150,000, half of that if you were single. But we'll take care of figuring all of that. It's just, I want you to be aware that if your income is over 150, at which point the credit phases out slowly, you could potentially have to pay back some of what you received, because this credit was calculated based on your 2020 tax return. And if your income winds up being higher, then the credit will be calculated based on your 21 tax. And again, if you're not eligible for all that you received, you will have to pay some of it back. So don't go spending it all in one place.
So that's kind of disappointing, because we had kind of a rough year in 2020, even with the pandemic, and you would have thought everybody would have been watching shows like ours. Everybody was watching Tiger King. I just don't understand it. So we didn't make very much money in 2020, but I think we're doing pretty good in 2021. Thanks for letting me know. I'm going to have to set aside some money. I might have to pay some of that back. Now, I've got some kids who are, if I add all those child tax credits together, that's still going to be a pretty significant amount. What if my tax isn't as much as all of that? Do I have to give back the extra amount?
No, you don't. Not this year. For 2021, the child tax credit is what we call refundable, meaning that you can get the credit as a refund even if you don't owe all that much tax, which in your case is a very likely scenario. But I don't want you to get too used to this big refundable credit. It only applies to 2021 unless Congress acts to extend it. After this, the credit amount will go back down to the $2,000 per child. The age limit will narrow, and it will become a non-refundable, well, partially non-refundable credit as it was in the past. We'll figure out all that when we do your tax return.
Yeah, I remember looking at my tax returns in the past, and there were credits all over the place. Some that were refundable and some that weren't, and I always got confused.
Well, we're going to talk a little more about that today.
Oh, well, thank you. So, do I still get credits for my kids who are too old for the child tax credit, but still haven't moved out of my house?
I know we all have a few of those hanging around, don't we? Well, that's the credit for other dependents. It hasn't changed. That credit's been around a few years, and taxpayers are eligible for a $500 credit for your dependents 18 and older. So that would be your students potentially living at home. It could even be your parents if you have them, if you're supporting them. Anyone who qualifies as a dependent qualifies you for this $500 tax credit. Now, as with most credits, this one phases out for taxpayers in the higher income brackets. The limit is a lot higher in this case. It's over $400,000 for joint filers, where this credit starts to phase out. But it's not refundable. So it's not refundable like the child tax credit. So for instance, if the child tax credit reduces your tax down to zero and then being refundable, you get some back, well, you're not going to get this $500 per dependent refunded. This will apply to taxpayers probably in a different situation than you.
So, help me understand this. If the child tax credit phases out starting at 150,000, but the other dependent credit doesn't start phasing out until 400,000, if my income is somewhere in between, could I end up not getting the child tax credit but getting the dependent tax credit?
I think that's the case. But sometimes we have to rely on our computers to figure out that stuff. The interplay can be very complicated.
This is why I trust you. Speaking of checks from the government, I got a really big check back in March. Do I have to pay that back?
Well, That was the third stimulus payment, or what we accountants call the economic impact payment. You might remember you received two of those in 2020, or you would have if you were eligible. This third one was brought to you early in the year by Congress and your brand new president. It was based on your 2020 income, similarly to the 2020 credits, which were based on the prior year income. But this one, the maximum was $1,400 for each of you and your wife and your qualifying dependents that were on your 2020 tax return, which would have included all your children under 18 and those kids of yours over 18 who are still full-time students. So that's a lot of people in your case.
It's a lot of people. Is there any chance I might have to pay some of that back?
No, not this year. In fact, you'll get to keep all of that money that was given to you, even if your income in 2021 makes you ineligible for the payments. So we'll be calculating your eligibility for this credit when we do your 2021 tax return. And if it turns out that your income was higher than 2020 and you received more than you were entitled to, well, then you'll be able to keep what you've already gotten. Now, this rebate, the income phase out starts at $150,000 for couples filing jointly, just like the child tax credit. But the difference there is that while you might need to give the child tax credit back, you wouldn't need to give back any of the money that you received early this year. So that's how that works.
Well, that's a relief, because boy, that was a lot of money when you have as many kids as I do. So a couple of my older kids, they've had babies of their own this year. They kind of have the same philosophy that my wife and I had. So they've already gotten pretty productive. And I want, since they didn't get any of those checks for those kids in March, I wonder, are they going to get another $1,400 for them too?
In fact, yes, they might. When they go and file their 2021 tax returns, or somebody does them for them, they'll reconcile the amount that they've already received for their family. So, married couple might have gotten their two $1,400 checks, but if they then had a baby later, it turns out they're entitled to $1,400 for 2021, then that will pop up on their 2021 tax return, and they'll receive that when they file their tax return. And of course, that's a refundable credit too. So that's not really a credit, that's more of a payment. So in any case, same situation happens if you have a student who was previously not a dependent, but was on their parents' tax return. They go out, they graduate from college, they didn't receive a $1,400 payment previously, but they file their own tax return for 2021, they'll get the $1,400 when they file. So some people have to wait, but the majority of Americans got their stimulus payment early in the year.
So as you may imagine, my wife and I lead some very busy lives. I pay my sister to watch my two littlest ones when we need to work on the show. Can I get a credit for that?
Oh, yes, there's a credit for that too. The dependent care credit has been around a long time, and it applies to folks that you pay to watch your children while you're working. It can be a sister, a brother, a parent, as long as you're paying them in order to do this work and you're out working. But that credit was doubled for 2021. But only for 2021. So again, don't get used to it. Previously, the credit was allowed for based on up to $3,000 of expense, childcare expense per child for two children, as long as you and your wife are working or looking for work. But now the expense amount is gone up to $8,000 for up to two children.
Two children, amateurs.
Yeah, right. So that's a total of $16,000 of expense, assuming you have two or more children. Now, you take that expense and you get a credit for up to 50% of those expenses, depending on your income. Now, the credit had been 35% of those expenses. So now not only has the expense allowance gone up, but the percentage has also gone up. So what that translates to is that the most you could get back as a credit is $8,000, 50% of the $16,000 limit. And that is a whole lot more than the $2,100 maximum that you would have been able to get back last year. So
Wow.
it's expanded significantly, but again, just for 2021. Now, of course, there are income limits on who can take the credit. And again, of course, you have to be either working or looking for work. You can't be cleaning up your workshop there behind you. If your income is between $125,000 and $440,000, you wouldn't get the full credit. There would be a phase out. Below $125,000, you would get the full credit, but you would get some up until the income limit of $440,000. This is a change from last year where there was no upper income limit, but in exchange for the richer credit, there is an actual cutoff point. So your most wealthy taxpayers are not going to get this dependent care credit. Now, one thing that is important, though, is to get the maximum from the credit. Your full $16,000 that will be eligible for it has to be paid before the end of the year. So if you've got a December bill hanging around for your sister, be sure to pay it before the end of the year.
Well, she'll enjoy that. Now, what if I don't actually owe $8,000 in tax? Will the credit just reduce my tax to nothing? What if my tax is only $5,000? After taking into account all my other credits, of course.
Right. Well, interestingly, we're back to this concept of refundable and non-refundable credits. The ARPA actually changed this credit to be refundable permanently. So while they changed the amount of the credit and the amount of eligible expenses for 2021, only for 2021, the refundable factor or aspect of this credit is now a permanent part of the law. So from now on, you would get that difference back, just like the child tax credit is refundable. In any case, adding all these refundable credits together, you could be eligible for quite a significant amount this year.
Wow, that's good news. So my oldest daughter, she's been out of work for a while, and she's got several kids of her own, and she's struggling a bit financially. Are there any benefits she can get on their taxes?
Well, if she doesn't have any children, she's not going to qualify for any of the credits that we've already discussed, because those were all to do with children and dependents. Mm-hmm. But she might qualify for a different credit as a low-income taxpayer. The earned income credit has been around a long, long time, and it's long supported some of the country's most financially vulnerable taxpayers, but it was expanded under the ARPA. So previously, the earned income credit applied to some very low income wage earners, but it was very low, like I think about $5,000 was the most you could earn and qualify for it. It's a lot more generous for families with children. Again, low income, but the credit is significantly more for folks with children. The ARPA didn't change those rules for taxpayers with children, but it did change them for single people, I think in recognition of the devastating effect that COVID has had on so many families. So your daughter could potentially be eligible for the credit if she's over 19 years old. Is she over 19?
She is, and now that you were talking, I realized I had gotten my daughters mixed up. The one that's having so much trouble financially, she doesn't have any kids yet. She hasn't even started courting yet. I don't know what's wrong with her, actually.
Well, as long as she did have some earned income, because the earned income credit applies only to people who do have some wage. Fully unemployed folks are not qualified for this. But if she's over 19 and she's got less than $11,600 of earned income, she could qualify for a credit that amounts to about $1,500. Now, this has expanded significantly because previously you had to be over 25 to apply to qualify for the earned income credit. And again, the income limit was about half of what it is. The other thing to make this credit more available to more people that's new, again, just for 2021, is that she can base the earned income credit on her 2019 income if that's more favorable than the 2021 income. So you have to compare, you can compare the 2 years. It gives a little bit more opportunity for folks to qualify for the earned income credit. Again, these are just rules for 2021. When we go back to 2022, the age limit requirement of over 25 and the lower credit amount for folks without children return next year.
Wow. I don't know how you're going to keep track of all of this, but I'm just glad I'm hiring you. Now, does it matter for her that she's got an investment account? Because over the years, I've given her some money just here and there, and she's built up a reasonably good investment account. Is that going to cause her a problem with the earned income credit?
It would have until this year. But again, trying to liberalize the rules, the ARPA expanded the eligibility for the earned income credit for people with investment income. So she would still qualify for it with those other income limits we talked about. But even if she has up to $10,000 of income from investments, as long as her earned income is less than that $11,600, she can have investment income of up to $10,000 and still qualify. And by the way, this provision is permanent. This is not just for 2021. You'll have to ask Congress why these rules are so complicated and some things apply for 1 year, 2 years, all years, but that's where that's sitting for the earned income credit.
If I got a chance to talk to Congress, I'd have a lot more things than that to talk to them about. So you sure have told me a whole lot about credits. Are there any others actually?
Well, for somebody like you, I wonder, have you added any energy efficient property to your home in 2021?
We did. We put up some solar panels and we got a new hot water heater that's super efficient. When you do as much laundry as we do, you go through a lot of hot water.
I'm sure you do. Well, thanks. So we go back to 2020, the CARES Act, which you probably remember was the first Coronavirus Assistance Act that was passed in 2020, and that was those first economic impact payments. A lot of other changes too, but most of them did not affect 2021. We're relying on the ARPA for that. But going back to the 2020 CARES Act, you'll be eligible for up to a $500 credit for your hot water heater. Prior to COVID, that credit had been eliminated. It had been in the law for quite a number of years, but the CARES Act did extend that into 2021. So there's a small credit there. I suspect in your case, you are going to be done with credits before you get to the energy efficient credit, but we'll see. But you're also in luck with the solar panels. And this one you may have a better chance at. Prior to the CARES Act in 2020, the solar tax credit would have been reduced to 22% of your eligible expenses. But now the 26% credit, which has been around quite a long time, has been extended into 21 and 22 before the slow reduction that was already in law begins to a 22% phase out. Now, this is not a refundable credit. So you wouldn't get any tax benefit from it here in 2021, but that 26% of your expenses related to the installation of the solar arrays you will be able to carry that forward, and you can use that tax credit when all these other tax credits of yours run out. So while it's not refundable, you can carry it forward.
Wow, that's crazy. So besides credits, is there anything else I could do to lower my taxes?
Well, do you have any charities you like to support?
Well, there are a few charities I'm partial to. They're related to pregnancy and childbirth, as you might imagine.
Well, that makes sense. Um, well, if you and your wife don't itemize your deductions, there is something that could potentially benefit you this year. There's a special deduction, which is what us accountants call above the line, because it doesn't apply. It applies if you take the standard deduction. And folks who itemize their deductions have a different type of charitable deduction. But before the CARES Act, the charitable contributions didn't provide any benefit for folks who took the standard deduction. The CARES Act allowed for up to $300 deduction for charitable contributions, even for those standard deduction takers. Now, the ARPA, rather than allowing the $300, extended the $300 credit to 2021 and doubled it. So where previously $300 per person was allowed, if you are married filing together, you're actually allowed to up to $600 of a charitable deduction, again, above the line. Now,
if I remember right, last year when you could only, it was 300 per taxpayer. So you only, if you were married filing joint, you could only deduct 300 for the both of you combined.
Right. It was kind of crazy the way taxpayer was identified, because we normally think of taxpayer and spouse as being two taxpayers. But in this case, they defined taxpayer more as a tax return, and the 300 was the top. But we got 600 this year. Now, there is another opportunity that really is not going to apply to you, but maybe you've got some wealthy friends who you could talk to about this, because the CARES Act provided for a one-time 2020 only provision that allowed somebody to give away 100% of their income and get a complete write-off for charitable contributions, as long as those contributions were made by cash or check, not gifts of securities. And that allowed folks in 2020 to reduce their income to zero by virtue of charitable contributions. The previous law had been a limit of 50% of your income, where you could then carry the rest forward. But under the CARES Act, we had this temporary provision for 100%, giving away 100% of your income and getting an immediate deduction rather than carrying it forward. So the ARPA extended that particular provision for 2021. So that allows some of the most generous among us to get an immediate tax deduction for very generous giving.
Wow, that's pretty cool. Yeah, that definitely doesn't apply to me. I don't have enough money for that. But you know, those TV company execs that we talk to all the time, they sure do make a lot of money. I'll have to remind them about that deal. So speaking of the TV company, my deal with them is that we're not employees of the company because we have the show, but we're contractors. So the money that they pay us goes on, I think our accountant called it Schedule C. And
Right.
last year we saved a lot of taxes by making some sort of deferral. Do you know what that's about?
Well, you didn't exactly save those taxes because it was a deferral. Sorry to tell you that. Um, you just didn't have to pay it all at once. Again, Congress trying to make it a little bit to sort of smooth the ride for some of our taxpayers, of course, not knowing that COVID was going to continue on into 2021. So that was just a one-time opportunity where you could choose to defer your up to 2/3 of your self-employment tax and pay it in installments. You've probably actually, I know there's probably a lot of mail in your house. I can see a lot of paper in the background. You may have likely already received a notice from the IRS informing you that your first installment of paying that money that was owed last year is due by December 31st, 2021, this coming up here in a few weeks. And then you'll owe the last installment of it a year from now. And there's no interest or anything like that on it, but you do have to pay that amount back. Now, that's not going to be any kind of factor on your 2021 tax return. It won't be paid through virtue of filing that return. It's really completely separate. but you are responsible for it, and the IRS will charge you interest and penalty if you don't pay it on time. So I hope you saved a little bit of that advanced tax credit money and can send some of it back to the government.
You know, it was a shame it doesn't go on my tax return, because then I could use some of those credits I've got.
Yeah, right.
So, any other changes with regard to my business?
Not too many. There's one that you could potentially take advantage of. Now that restaurants are open again, or at least partially open, you could take an advantage of an increase in the deduction for business meals. So for 2021 and 2022, pretty generous. Congress has recognized the distress that not only business owners, but restaurant owners are in. So in order to encourage business meals, you're allowed to deduct 100% of the cost of business meals that you eat at restaurants. So whereas previous law had always been you could deduct 50% of your meals, it's now 100% as long as it's eaten at a restaurant. So just be sure that any of your business meals do have a business purpose, and you'll be able to write them off 100%. Now, that's not a tax credit. That's a deduction, and that deduction you will, even if you don't get advantage of it this year, you will be able to take advantage of it as part of your business expense. And that affects your overall income. The restaurants will really appreciate your support, and I can highly recommend a place across town owned by Madame de Rosé.
Oh, she's a good friend of mine, actually. I was going to suggest I might go to see her. So, you know, we've homeschooled all of our children. I don't know how my wife's done it, but it's worked pretty well for us. And one of my older sons, well, he decided to go to one of those fancy colleges and took out a bunch of student loans. Now, he ended up becoming a teacher, so some of his loans were forgiven. Will he have to pay tax on that?
Possibly not. Actually, likely not. Depends on the type of loan. But as the ARPA gives taxpayers who have loan forgiveness, like your son, a break for the years 2021 through 2025. In most cases, the loan forgiveness won't be taxable to him during these years. So that's a pretty good deal.
That is. What about health insurance? Seems like that's the only thing going up as fast as college tuition. Ours went up a lot again this year. We get our coverage through the exchange, and we've gotten a tax credit in the past.
Oh, we got somebody on the. I guess we're okay.
Oh, awesome. Good.
Somebody's got their mic on out there.
I'm pulling it up now.
All right. Well, we'll continue.
Okay.
So
the health insurance has gone up as fast as college tuition, and we get our coverage through the exchange, and we've gotten a tax credit in the past to help with the premiums. Is that still available?
Oh, here we go with credits again. The ARPA did expand eligibility for the premium tax credit quite significantly, and it also increased the amount of the credit. So this year, right? All taxpayers, regardless of income, so this is very different, will potentially be eligible for the tax credit, and the credit is greater than it has been in the past. The ARPA rules apply for 2021 and 2022. So this is a little bit different from some of the other changes that ARPA made, because they do extend into 2022. So the bottom line is that the premium tax credit is fairly confusing, but to calculate. But the end result is that it tries to limit the amount of household income that a taxpayer has to pay for health insurance premiums. So the bottom line is that the most that a family on the exchange will have to pay for health insurance premiums is 8.5% of their household income. And that's a reduction from about 9 or 10% in prior years. Most significantly, there is no upper limit on earnings for this premium subsidy this year. So obviously at some point, the income becomes so high that the 8.5% is less than the premiums, or is more than the premiums would cost you anyway. So at some point there's no subsidy, but until that point, the 8.5% of household income is going to be what the limit is. So that's going to affect some of those folks that really got hit hard in past years, where their household income was over the limit, and there was actually a drop-off cliff where if you were just $1 over the income limit, you got no premium subsidy whatsoever.
I had a friend that happened to. They were not happy with their accountant.
Well, it can be pretty tricky to calculate exactly where your income's going to fall, and it really was a $1 over that cliff, and you were paying the full amount of your premiums, which was very significantly different. And I think, just as an example, a household of two, that figure was about $70,000 of income, and if you were at all over that, you got no subsidy, compared to quite a significant one under that. So there's been a big change there. And then furthermore, for 2021, if you happen to underestimate your income, and you turn out not to be eligible for as much as you received in advance credits, you won't have to repay that credit that you already received on your tax return. Now, you won't get any additional, obviously, but again, that's a change, because in past years, if you received an advance on that credit, which most people did, most people would submit their income from the prior year, there'd be a calculation of this is how much credit you qualify for, and some of this credit will be offered to you in advance to help you with the monthly premiums. If it turned out that your income was higher than you had projected or expected, too bad for you, you had to pay back. And that created a significant tax liability for some people if their income was unexpectedly higher than they had estimated. That's not the case this year. To the extent that you received any advance credit, that doesn't need to be paid back. So again, and this is 2021 and 2022, that's a significant expansion. There's another provision that's new this year that could apply potentially to some of your adult children. Were any of your adult children collecting unemployment during 2021?
Yes, one of my sons was laid off his job this summer, and he's been looking for work ever since. Poor guy, the health insurance premiums are just terrible. But he was earning about $150,000 a year before he got laid off. Would he still be eligible?
Well, if his income was high enough where he might not otherwise be eligible for the premium tax credit, this year, again, now this is 2021 only. So again, us poor accountants have to keep track of what's the case for this year versus next year. Anyone who collected unemployment in 2021, even for 1 week, is subject to much lower income restrictions and a much more generous benefit. So it's important to let your accountant know the entire picture, because that's that can make a very significant difference in how much subsidy he's going to be eligible for, despite a relatively high income. Just trying to give some allowance to folks who, have had a harder time than expected this year.
Well, I'll tell you, speaking of my children's accountants, we are all going to be bringing our taxes to you, because you really seem to know what you're talking about. And so you better set aside some extra time this tax season for all of that. Now, one last thing. We've been very blessed financially. Who knew having a ton of kids could be a smart financial decision? So while we've accumulated some assets and we've been giving money to our kids and grandkids each year for a while now, and we've done a little bit of estate tax planning. Any changes to any of that stuff for this year?
Well, it's never too early to start planning for the future. You mentioned that you'd been giving your children a little bit of money over the years. Don't know how much, but your children will be happy to know that should you have enough money left over from all these tax credits, you and your wife can each give up to $16,000 a year without reporting those gifts to the IRS. That starts in 2021. For the last 4 years, the limit for giving was $15,000 a person. So that's going up $1,000, increasing that limit for the next several years for each person. Again, each person, each of you and your wife. So if you really hit it big with its TV show does great, you could potentially set aside $32,000 for each of your children.
For each of my kids? How much money do you think I have?
I wasn't saying I thought you should. I was just saying that I thought you could. So yeah, that limit has gone up. That's just an inflationary limit. That's nothing to do with the ARPA. That's just an inflation adjustment. And if you're thinking really big, and I don't know that this would apply to you, but another inflation adjustment for related to estate and gifts is that the estate tax exclusion, which is the amount that is non-taxable upon your death, is going up to $12,070,000. That's not a number that applies to a great number of families, but that means that $24,140,000 for a married couple can be sheltered from estate tax for 2022. That's a very significant. It's an inflationary increase, but that's a significant amount. And again, not a change, but those large estate tax figures will be going back down in 2026 unless Congress acts to either sooner reduce that amount or extend that amount beyond 2025.
Well, you sure have been helpful, Ms. Downs. Now, if you don't mind, I've got to go to Costco, and I've only rented the U-Haul for a few more hours, so I have to get moving. Thank you so much for your time.
Oh, you're very welcome, Mr. Duggan. Good luck to you.
And Thien. Now, we do have one question from the comments. How is household income defined for the premium tax credit?
I believe that it's basically AGI. There may be some adjustments to it. I think it's basically AGI, though.
Okay. Are there any other questions before we get ready for the next scene? All right. The next code word, this is the third code word, and it is quiver. Q-U-I-V-E-R, quiver. Now we'll take a short break and we'll be back for the next scene. Not yet, Mr. Stoner. That was a short preview of coming attractions.
David, has the question from Lexan Hove been answered?
I did not see the question from Lexan. Just 1 second. Let's see. Is the due date for the self-employment tax deferral installment payment still in December for both taxpayers who filed in April 15th and those who filed by the extended date of 10/15? I don't think it makes any difference when you filed.
It doesn't. It's due December 31st, regardless.
All right.
Good question, though.
And next scene begins.
Good morning, Mr. Harris. Thank you for making time for me.
You're very welcome, Dr. Franklin. I'm very glad that you're considering our firm for your accounting needs.
Well, the reason I'm reaching out today is that we got an inquiry from a private company that specializes in the research and development credit. After a brief conversation, they told us that we should have been taking this credit all along, and it could have saved us thousands of dollars. They said our old firm should have been doing this, and so we decided we better go and find some better accounting representation.
Didn't that company also try to convince you to let them apply for the credits for you?
Yeah, in fact, they did. But they wanted to take 15% of the amount of the credit as a fee. And their promise of supporting any potential audit meant nothing more than supplying a few work papers. I wasn't that impressed. They were so certain that we would qualify based on just that very brief conversation. It kind of gave me a bad feeling. So I thought maybe a full service accounting firm would be able to give me a more balanced picture of our options.
Those are some very finely tuned instincts you have there, Doctor. Our experience is that those companies are very aggressive in claiming the credit for activities that may not qualify as research under the regulations. They don't do anything that's openly fraudulent that I've seen, but they stretch the definitions more than I would be comfortable with. And the work papers that I've seen from them to support the amounts that they claim are basically boilerplate, and they don't seem to fully address a specific client's situation.
Well, I'm certainly glad I came to you then. I will say there is no stretch in calling our business a research activity. Along with my colleagues, Doctors Watson and Crick, I've been doing some cutting edge genetic research for a couple of years, and we've made some remarkable discoveries.
That's very exciting. It's hard to believe your prior accountant never discussed this issue with you.
Never even brought it up.
So you mentioned that you had been in business for a couple of years?
Yes, we started the company in 2019. Prior to that, we all had jobs at a university, but we decided to strike out on our own.
And have you been able to generate any revenue yet?
Well, we got some grant money for one research project, but other than that, most of the funds to support our research have come from outside investors.
Well, that might create a little bit of a problem for that one project because generally speaking, if you do research for hire, that somebody pays you to do the research for them and they own the results of that research, and then if you still get paid regardless of whether the research pans out, that's called research for hire. And generally speaking, you're not the one that qualifies for the credit. It would be the person who paid you to do the research. So that project probably doesn't qualify. But aside from that, all your other projects, you own the results of the research and you bear the risk of loss?
Yes, that's correct.
Well, it seems obvious that your work would qualify, but let me quickly go over the components of qualified research. So the first thing you have to be doing is you have to be developing or improving a new or existing product or process. You have to be engaged, you're eliminating a technical uncertainty. So there has to be something that you don't know yet whether it works and you're trying to figure out if it does. It has to be a process of experimentation. So you have to be coming up with ideas, testing them, and seeing what works. And then finally, it has to be technological in nature.
Well, we definitely meet those qualifications. I feel sure of it.
Okay, well, that's good. Now, how is your business organized? Is it a corporation, a partnership?
It's a partnership, I think. I mean, it's an LLC.
Okay, very good. So let's talk a little bit about how that credit works. If you're a corporation, you claim the credit on the tax return and you use the credit against your taxable income for the corporation. But if you're an LLC, it works a little bit differently. The credit actually gets passed out to the shareholders. So there's lots of complications here. In your case, where you've had a couple of years where you've been doing some research and then you didn't file the what's called Form 6765 to claim that credit in those years, we can go back and amend the tax return, and once we figure out what the amount of eligible research expenses is, we can claim that credit. Now, the problem is in a situation like yours, I would recommend that you take the reduced credit, because right now, once you calculate and go through all of the hoops that you jump through to come up with your amount of qualified expenses, then you get a credit for 20% of that amount. But if you take the full 20% credit, then you have to add back into income or reduce your expenses by the amount of the credit on the tax return. So you get a credit, but you also lose a little bit of your deductions. Now, that's a good deal, but it's something you need to be aware of. And in some situations where your credit might not be useful right away, but the deductions would be useful, you can actually end up with kind of a bad result in the short term. So I will advise people to take the reduced credit where you can just check a box, and instead of taking a 20% credit, you would reduce it by the amount of the federal income tax, which is 21% of the corporate rate. That's the rate that you use for everything. So 79% of 20% is 15.8%. So you would take that amount of the credit. The problem is that you cannot do that on an amended return. So we would have to have timely filed the returns in order to claim that reduced credit. So now if we do go back and claim it, not only are you going to get a credit that's allocated to you, but you're also going to have higher income or a lower loss in those years coming through on your K-1.
Wow, that all sounds really complicated, but we could still get a big credit, right?
Well, you could generate one, but it might not do you any good right away. And since you can't elect the reduced credit, we would have to amend all those returns. And the credit that you get on that, you might not be able to use. For instance, you have you're limited in the amount of the credit that you can take by the income that comes from the activity that generated the credit. And so since you're still in the pre-revenue phase, you wouldn't have any positive income that would allow you to take the credit. So that's likely going to be suspended in your situation. Now, there is one other option that we can do, we could potentially have done, which is that a small business like yours has the possibility of taking that credit rather than passing it out to the shareholders, or if it's a C corporation, rather than taking the credit against its corporate income tax, which it might not have any of, you can actually elect to apply up to $250,000 per year against your payroll taxes. So your payroll taxes you pay for your employees, you could potentially take up to $250,000 a year of your R&D credit and apply it to those payroll taxes, so that when you file your returns, you take that credit and you get a big refund. Well, that's great going forward, but unfortunately, that has to be done on a timely filed return. So again, if we're going back and amending for prior years, we won't be able to make that election for the payroll tax credit.
Well, that's disappointing.
Well, it is, but there's another new wrinkle for 2022. Up to this point, R&D expenses have been fully deductible in the year that they are incurred. So that rule has actually allowed immediate deduction of some costs that otherwise would have been capitalized. It's section 174 of the code, and deductions that fall under that were subject to some pretty generous deduction rules. Now, you have I assume that a lot of your money that you have used to fund your research is coming from outside investors. Is that correct?
Right, that's right.
And those investors are not active in the business. I assume that you and Drs. Watson and Crick do have an equity interest in the partnership, correct?
Right, and the investors are not active.
Right. So when you get those expenses passed out to you, they would come out as something called Section 59E2 expenditures, which are subject to some rules. And as long as you're actively involved in the trade or business that generates the credit, then you can deduct those just like normal. But for your investors who are passive, they actually have to amortize those over a period of 10 years so they can't get an immediate deduction for those. So again, that gets back to, they get a credit that they can't use because there's a loss. They get 5092 expenditures that they can't deduct because they have to be amortized. It's not really the best deal for them.
Well, if we do our job properly, it will be eventually.
It will be eventually, and everyone, as one of my colleagues likes to say, every research startup is 18 months from profitability, always. But as part of the Tax Cuts and Jobs Act, beginning in 2022, all R&D costs, no matter whether you are active in the business or not, will have to be capitalized and amortized over 5 years. And that's only if the work is done in the US. If you have some foreign research being done, that has to be amortized over 15 years.
Wait a minute. Let me understand this. If we have $1 million of R&D expenses, which pretty much is all of our expenses, in 2021 and 2022, for 2021, we could deduct the entire $1 million as a loss. But for 2022, we'd only be able to deduct 1/5 of that amount?
Actually, it's worse than that. You only get a half year of amortization in the first year. Then you get 4 full years, then another half year at the end.
Wow. So we lose out on $900,000 of deductions in 2022 just because it's R&D costs instead of regular business expenses? That doesn't seem fair.
I'm afraid that's correct. And if your activity stayed steady for the next several years, it would be 2027 before you'd be deducting a full $1 million per year for R&D.
Well, but our investors count on those losses being allocated to them and using them to offset their other income.
That's true for a lot of companies like yours. But if Congress doesn't fix this soon, I'm afraid the available capital for R&D startups may start to dwindle away.
So is there a chance Congress might fix it?
They might. Bills have been proposed to do just that, but counting on Congress to enact effective and timely legislation to fix obvious problems has historically not been the surest of bets. We should prepare for the worst.
Well, so what can we do?
Well, let's look at your situation. As you have been filing, you're generating a large loss that's fully deductible each year for your investors, and you're not generating a credit. By claiming your cost as R&D, you'd be generating a credit that, if you claimed it, would do your investors no good for many years and would cause positive adjustments to income in prior years if you amended it. You could take some of the credit against payroll taxes for a few years, starting now, but your payroll provider might balk. We had one payroll provider that was a substantial one that basically said, we're not going to do the R&D credit, and if you go and file amended returns to claim it, you won't be our client anymore. We're just not going to deal with it. And then you'd also be substantially reducing your losses available to your investors in future years, potentially because of this amortization rule. Is there a way that perhaps your expenses aren't R&D?
I think that would be very hard to argue. I think this is hilarious on some levels. I mean, I came in here hoping for you to reassure me that our activity does qualify as R&D, and now I hope you're telling me it doesn't.
I know, this year is causing some strange conversations for me. I'm not saying that claiming the R&D credit is a completely bad thing. It's likely that Congress will fix this amortization issue, and I'll take $1 of credit for 40 cents in lost deductions any day, even if I have to wait a little bit longer to realize it. But most importantly, I can't sign a tax return saying that costs aren't R&D when I know that in fact they are.
Should I go back to my old accountant?
And see. Do we have any questions related to R&D credit or R&D expenses?
No, it doesn't look like we do.
All right. In that case, our next, our fourth word is laboratory, to use the British pronunciation. Laboratory, Laboratory. Now we'll take a brief break. Yes,
David, before we break, there is a comment, the Build Back Better bill, which of course hasn't passed yet, may push the requirement to capitalize R&D costs out to years after 2026. Of course, we don't know whether it'll stay in the bill, whether the bill will pass, but it's clearly being talked about in Congress.
It is definitely being talked about. Any speculation about the Build Back Better bill, you'll be advised to tune into Chris Brubaker's session later called Tax Speculation. There'll be a lot of talk about that. Jerry, the word was laboratory. All right, take a quick break. We'll be right back. And Mr. Cam, this would be your time to get ready.
Hello?
Hello?
Hello? Hey, man. Hello?
Hello?
Hey, man, what's up?
Hey, have we met?
Oh, my bad, man. Let me put my breakfast down here. My name is Eugene Stoner III, but everyone calls me Mean Gene. So how was your Thanksgiving?
I had a very nice Thanksgiving, actually, a wonderful dinner with extended family. How about you?
Oh, it was great, man. I went to my mom's, which meant I walked from the basement to the kitchen, and she said she's going to smoke this big bird, man. And her idea of smoking a big bird and my idea of smoking a big bird are two different things, man. But it was good. It was good. I hear that you're the person to talk about tax stuff, man.
Well, I am a CPA. I'll do the best I can. You know, your name sounds very familiar to me.
Yeah, my granddad was the guy who invented the AR-15, but the gun business kind of harshed my mellow, man, if you know what I mean.
I suppose so. What business did you go into instead?
I've got a couple of vape shops and another shop that sells, well, glassware. But now that weed's legal in Virginia, I'm thinking about expanding my operations, man.
Do you have any experience in that industry?
Well, not officially. Let's just say it's an area of interest.
Very good. Well, there are a few things that you should know before you get into that business. The first thing is that even though possession of up to 1 ounce of marijuana is legal in Virginia as of this past July 1st, it won't be legal to buy it in stores without a medical marijuana card until 2024. And they've already authorized the maximum number of medical dispensaries, so you can't open one of those yet.
Yeah, I got a lot of buddies that already have their medical cards. So I have to wait until 2024 to start my retail business?
That's right. And even then, you've got some issues. You see, the federal government still classifies marijuana as a Schedule 1 drug, at least if it has more than 0.3% THC. That's the part that gets you high. So even though it's been legalized in Virginia and many other states, it's still illegal at the federal level. That can cause a lot of problems for a business.
Such as?
Well, to start with, you can't deduct all your expenses.
Dude, seriously.
Yeah, there's this section of the code called Section 280E, and it says that when you're operating an illegal activity, you cannot deduct most of the expenses that you pay in that activity. You can just deduct your cost of goods sold.
But I can still deduct the price I pay for the weed, right? That's the problem? What's the problem? I'm sorry.
Well, you have to rent a storefront, right? You're not out selling on the street.
So I can't deduct my rent?
Nope. And you have to pay your employees, right? And the payroll taxes, benefits, all non-deductible.
You are seriously killing my buzz, dude.
Sorry about that. There's also utilities, repairs, advertising. Can't deduct any of that.
Bummer, man. Anything I could do about it? What if I sell stuff besides just weed, like that glassware I mentioned earlier? Or funny t-shirts, man. I've got this one that says, "Sorry for the bluntness. That's how I roll, man." I don't get it, but everyone laughs at it, man.
It's very funny, but that won't help you. The Harborside case decided that.
Wait a minute. If it's illegal business, then I shouldn't have to pay tax at all on it, right?
I'm afraid not. Didn't you see the Untouchables? They got Al Capone for tax evasion.
Well, there's got to be something I can do.
Well, there is something. If you can have businesses that operate each stage of the process, from cultivation to extraction to manufacturing to retail, then you can move a lot of your expenses into the businesses that don't engage in what the IRS considers trafficking. We call that vertical integration. And that way, more of the costs can be treated as cost of goods sold by the retail business, which could reduce your tax burden. But you'd have to have a lot of capital and connections to make that happen.
Well, thanks to my granddad's invention, money isn't a problem. And I've got lots of connections, man. But you said there were several problems. Are there more than just the expense deduction thing?
Well, the other major challenge you face is banking. Most major banks are not going to do business with what the federal government considers to be a drug trafficking business.
Yeah. Well, I don't need any loans, man.
But you do need to deposit your receipts, right? And pay your bills. You'd have to deal exclusively in cash, and your customers couldn't use credit cards to pay for their products.
I don't like you anymore.
Don't shoot the messenger, especially not with an AR-15. Having that much cash as well as weed around means you've got to have lots of security, which you also won't be able to deduct. And it means you really have to trust your employees.
Is this going to get any better? I mean, so many states are legalizing weed now. You think the feds would ease up?
Well, there's been legislation proposed to deschedule marijuana at the federal level, but nothing that's come close to passing yet. If I had to guess, I'd say it would probably happen in the next few years, but it's hard to say for sure.
Dude, you know what I just realized? I don't have to use cash for weed sales. I can take crypto.
That's funny. Pretty much the first thing Bitcoin was used for was to buy drugs. You ever hear of Silk Road?
Oh, yeah.
You're right. I'll bet you're very familiar with that. You're right. That solves a lot of problems for you, but it's not like the early days when crypto was the Wild West. A lot of government agencies have started to look a lot closer at cryptocurrencies and to regulate them pretty heavily.
What do you mean?
Well, you may have heard that a couple of years ago, they pressured the exchanges, the places where you go to trade crypto back and forth with other people. They pressured them to give transaction info to the IRS. So Coinbase and a lot of similar companies gave all the information out on all the transactions they had to the IRS. The IRS also put a question on the tax return asking if you had engaged in any crypto transactions. And then last year, they sent out letters to people who were identified by the exchanges, reminding them of their obligations.
Oh, I remember all that, man. Is there anything new this year?
There is, in fact. You remember that bipartisan infrastructure bill that was passed in November? There was a nasty little provision in there regarding crypto that has a lot of people upset.
What's that?
Well, similar to the information they're requiring from the exchanges, they're requiring brokers to collect information about the parties to the transactions they're involved in and report to the IRS, just like your brokerage company, like your Wells Fargo or your Davenport, would send you a 1099-B every year for your. I'm guessing that you don't have a lot of your money in stocks and bonds, but anyway, for those people who do, they get these 1099-Bs and all this information, and anybody who's considered a broker is going to have to provide all of that information. The problem is that the definition of brokers in the legislation is so vague that it could potentially include almost anyone who engages in any crypto transactions.
Well, that sucks.
The good news is there seems to be a bipartisan consensus that it went too far, and a bill has been proposed to fix the wording. It seems likely to pass, but it hasn't yet.
So what you're telling me is that I can't open a weed store yet, but when I do, I won't be able to deduct my expenses or use a bank. And if I take crypto, I get regulated like Goldman Sachs.
That's what you get for living in the land of the free. It do be like that, though. The government always wants to encroach on your rights. It really gets my nose out of joint. But what you ganja do about it? And scene. Next word for our attendance is reefer. Thank you very much, Mr. Stoner, for your assistance. Reefer, R-E-E-F-E-R, reefer. Are there any questions on any marijuana or crypto-related transactions?
Could you repeat the word? I'm sorry.
Reefer, R-E-E-F-E-R. Did Mr. Stoner engage us? No, I think he kind of passed out at the end of the conversation, and we won't hear from him for a while. All right, so we're going to take another brief break. If you have any questions, go ahead and fill them in the chat function, and we'll address them. But there is a special guest that will be coming momentarily.
Oh, greetings. Keyboards click. Are you listening? On their brows, sweat is glistening. They're toiling away day after day, working in a building that is new. Gone away is the old place. Here to stay is the new place. It really was rough to move all our stuff, working in a building that is new. In the office, we can roam the hallway, meeting those we've never seen before. We'll stop and have a chat about the ball game or what we need to pick up at the store. Later on, when you've clocked out, make sure you don't get locked out. Have your key card with you when you go to the loo, working in a building that is new. In the office, we can hear each other talking from 100 feet away. So we know all about your crazy brother and all the other private things you say. Everything is so shiny. Our complaints are so tiny. We'll work and we'll play the HW way, working in a building that is new. Working in a building that is new. Working in a building that is new.
And that was our special guest. For those of you who don't know, we have moved our office from the building on Jefferson Street that we've been in since the 1950s, I believe. And now we are over at what used to be the LexisNexis building. I don't even know what they call it now, but we've been getting adjusted to that. So that's been a lot of fun. Do we have any further questions? All right, we still have about 10 minutes to fill, so somebody had better come up with a question or two. I do have prepared a list of options for from Kiplinger, some options for things to do at the end of the year that might help your tax situation. So we'll go through those for a little bit. Number one is to check your withholding. So if you have not been having enough withheld from your paycheck to cover your tax bills, it might be a good time to go ahead and adjust your withholding for next year so that you don't have that problem again. You might consider paying some 2022 bills now. So the there are certain thresholds that you hit, like Helene talked about the standard deduction threshold and charitable contributions. If you're getting close, if you think you'll be close to getting the 24,000 for the standard deduction or whatever the number is for this year, then you might want to go ahead and pull in some donations that you were planning to make in 2022 and go ahead and make them before the end of this year so that you get over that threshold and get a tax benefit where you might not get it if you just do it evenly. You might prepay tuition for the same reason. Look at your tax situation, talk about it with your accountant, and then if it makes sense to accelerate anything, that would be a good time to do it. Again, these things that I'm pointing out, it's not for you personally to do, but things for you to be aware of if you're having conversations with clients toward the end of the year. You might want to harvest some losses. So, this has been a very volatile time for the stock market, and you might find that you have some investments that have not done as well. You weren't in Tesla or so forth. So you may want, if you've had some gains from some things that you've done, you might want to go ahead and harvest some losses, some things that are underwater right now, to reduce that tax burden. There's a question that popped up from Dave Halloran. Good to see you again, Dave. Going back to restaurant meals being fully deductible, are you including meals from hotel restaurants in the 100% deductible bucket? I've talked to people that think that's a little aggressive. I'm curious about how you feel. I'm not an authority on the subject, but I would say restaurant is restaurant, and you might want to say that room service might be a little aggressive, but I can't see why it would be a problem if you went to the steakhouse that's located in the lobby. I don't see how that's any different from going to a restaurant that's a standalone. Next, we have capital gain distribution. So if a client's getting ready to invest some money, say they won the lottery and they're going to put that money into some mutual funds, they might want to check to see if that mutual fund has made their capital gain distributions for the end of the year yet, because it's counterintuitive, but when you put money into a mutual fund and then you immediately get a capital gain distribution, you're just getting your money right back, and you are getting a tax hit that goes along with it. It's not really any new income to you. It's just a tax hit. So you might want to wait until after the distribution is of capital gains. It might be a good time to max out pre-tax retirement savings, whether that's a 401k, whether that's a SEP contribution and so forth, a Roth IRA. So there's lots of possibilities there for getting some of those deductions in. When it comes to charitable contributions, one of the things that I love to talk to clients about is a donor advised fund. So you might have a chunk of money that you want to give away, but you like to do your due diligence before you give money to a charity. So you want to do some research, and hey, well, it's the end of the year, I don't have time to go through all my normal process. You can put that money into a donor advised fund, and then you can hold it there, and then you can advise them on the fund on how they should distribute that money. They're not obligated to give it to exactly the charities that you indicate, but most of the times they will accommodate you for that. So that gives you a chance to accelerate the deduction now and then decide later what specific charities you want it to go to. We talked about charitable donations, non-cash contributions being a big part of that. Maybe while people have some time off around the holidays, they can do some decluttering. Maybe they got some new clothes and want to get rid of some old clothes. Making that donation before the end of the year to Goodwill or so forth can be helpful. We talked about donating cash to charity if you take the standard deduction with that $600 limit that Helene talked about. And then you can do the for 2020, a lot of IRA, you were not required to take a required minimum distribution from your IRA, but that was back for 2021. And anybody who hasn't done it yet still has the option to convert up to $100,000 of it as a direct charitable contribution, and that way it goes directly to the charity and never shows up in the income of the taxpayer. And then finally, you could consider a Roth conversion, which if you know that you've got a relatively low income in 2021 and you've got a lot of money sitting in a Roth IRA, this might be an advantageous time to go ahead and do a conversion and recognize that IRA money as taxable income and pay tax on it in the current year, and then put the money into a Roth IRA where it can continue to grow tax-free and will never be taxable when you take it out. So that's something to consider if you've got a low income year. So we did have a couple questions come up about marijuana stuff. I can't believe that's so popular, but here we go. Brad asked, hey, good to see Brad. Does the Fed consider the medical licensed people as trafficking? My understanding is that if you are a licensed medical dispensary, then that is different, maybe. But I have not. I think you still got. I know you still have the same problems with the deductions. I think it's still illegal at the federal level, and medical is legal for many more states than what recreational is. But there are some. It's something you'd really want to look into, but I know that it's something we dealt with before, and it's something that I had attended a class on a number of years ago. before any of the states had legalized it recreationally, and they were still dealing with those 280E issues with regard to expenses. So Glenn asks, in DC, it's legal to possess and use marijuana, but not to sell it. So vendors sell such things as t-shirts or stickers and offer various cannabis-related products as free gifts. Does it count as trafficking if it's being given away? I'm going to refer to a sales tax concept called true purpose. What is the true purpose of the transaction? Are you buying a t-shirt or are you buying weed? I would say that if the value of the giveaway is more than the value of the item purportedly being purchased, most likely your true purchase is the weed, not the t-shirt or the sticker. So I'm not a lawyer, so I'm not going to opine on the legality of it, but I would strongly suspect that that would not get you out of the trafficking definition. And then Jim asks, love the Roth conversion idea, but may there be a FAFSA downside to that? That's the free application for student financial aid. I have no idea. I think it would be taxable income, and I think that, yeah, that's another thing to consider. You might have a low income year, but boy, that might be really, really helpful to you in terms of getting some financial aid for your college student. So before you do that Roth conversion, you definitely want to check in if you do have a college student, that you want to check and see if you have if you're going to cause yourself any problems by doing the conversion. If you buy enough weed, you would buy a t-shirt. Well, I suppose that's true. All right, so that is 10:10. That is our 100 minutes. And if no one else has any further questions, thank you so much for your time.